Interesting stuff. Okay, let's move ourselves on, shall we? I was meant to talk last week about Diageo, which is a company we talked about not super long ago on this show, but things are moving. They're moving reasonably rapidly at the moment with that company, and their latest trading update I thought was kind of interesting. So let's talk about that for a little bit, and then we can come back to making your cavities bigger, Steve. Organic sales for Diageo were up 6%, which is much more like it from a company that's been struggling recently for, well, any kind of growth whatsoever. Sort of between, I think, around 5 to 7% is their kind of medium-term guide. They pulled their medium-term guide in the face of tariffs, but they were kind of not that long ago guiding for somewhere around this level. And that came from sort of about 3%, just under, in terms of volume, and slightly more than that in terms of what they call price mix, which is basically higher prices or better, higher priced stuff. Growth in the US, which is their kind of biggest and most important market, was around 7%, and Latin America and the Caribbean, which had been the kind of starting point for where the trouble had been coming from with weak results over there. Sales were up 29%. Now, that's off a pretty low base because they had been cratering, but it is a big number, 29%. So encouraging to see things pushing in the right direction there. That's roughly where the good news ends, though, as far as I can tell with this particular update. So the Diageo, I think, to their credit to some extent, did point out that growth in the US is largely the product of demand pulled forward. So the tariff news changes almost daily. As we kind of record this, some of Trump's latest tariff ideas have been stopped by the courts. His more kind of enthusiastic tariffs have been stopped by the courts and ruled illegal for the time being. Whether they'll find a way around that, whether something else will happen, who knows, whatever. But at the time they were saying, yeah, stocking up basically in the US is pulling demand forward. That's why we're seeing 6% growth here. It's not something that's likely to be particularly sustainable. And if they try and adjust back for this, and I think they're doing their best to try and adjust back for this, they get to a number that's around 2.5% in terms of organic growth. That's not a particularly impressive number, 2.5%. That's inflation-ish growth levels. What I would say is I think it's reasonably. I'll be interested to see what happens with Apple around this as well. Steve, you suspected there was demand being pulled forward from them. They were saying nothing of the sort. Diageo, I think to their credit, are calling this demand pull forward. And actually, you don't have to take their word for it either. I was doing some digging around this, and I think there's good evidence that Deborah Crew, when she says this, is pretty spot on. So the US operates on a kind of interesting alcohol distribution system that comes from Prohibition. We have talked about this before, but basically Diageo doesn't sell direct to retailers. It sells into wholesalers who then sell into retailers. And that actually suits the company quite well because it means they don't have to negotiate with the likes of Walmart and so on. And they can't find themselves getting asked for preferential pricing in exchange for this massive retail network that they have, or access to this massive retail network that they have. But what it does mean is that since there is this additional layer of US wholesalers, there are inventory levels that can be measured quite effectively here, which you wouldn't have if you were just selling directly into supermarkets. So there is an index of US wholesaler inventories to sales ratio, which comes from the St. Louis Fed, and I found it there, and I looked up where this was at. The level, Steve, you'll be interested to know, is just below 1.7 at the moment, which means absolutely nothing by itself. But 10 years ago, that level was at 1.1, and its 10-year high is about 1.7. That's where it was in the start of January 2023. So what that should tell you is that inventory levels are high in the US at the moment in this sort of stuff. And when inventory levels are high, that means a couple of things. It means that pricing isn't terribly strong. Usually we've seen various industries kind of coming out of COVID battling against high inventory levels, mostly in the kind of medical supplies and diagnostics-y stuff where people had been piling up this stuff as fast as they could and now just working through it instead of buying any more, quite reasonably. But I'm expecting something similar to that coming for Diageo, which is possibly, to my mind, the biggest of the red flags at the moment. They also announced their kind of plan of a strategic shift to premium ranges. They're already kind of premium-ish, but their plan for offsetting tariffs and so on and so forth, and the effect of GLP-1s and millennials drinking less and all the other stuff that you hear about in this area, is they're going to push towards the premium end of their portfolio. Okay, that largely means divestitures. question is what's getting sold. Guinness was kind of immediately mentioned as a candidate, and I do think it makes sense. Their basic plan is to try and take share from beer and wine using spirits. It doesn't make an awful lot of sense to be in the beer space in that case, but the problem with this is, and I also don't view Guinness as particularly premium. I get that it's the branded stout, but it's not a. I don't see that as a premium product. The trouble with this idea, they might sell Guinness, is they've said they won't in so many words. And I think it unlikely they will go back on this. The sort of more obvious candidate, based on the kind of recent results, would be something like Smirnoff. But I don't love the idea of shifting their portfolio around at the moment. I kind of don't mind cutting away weaker things. But my recent experience of this is that companies trying to cut away their weaker lines to focus on their stronger ones, it better work in the stronger ones. So far, I haven't had much joy with owning WH Smith while they dump their high street retail, or DCC while they sell off their healthcare division, or basically anything selling anything right at this particular moment. The real hope is that their premium lines will work in that case if they're going to cut away these other things. I previously said, when I wrote this up for Motley Fool, I said I was bullish. But I guess deep down, I do regret buying shares above these levels. It's been hanging around here for a little while. The stock wasn't massively moved by this, and I can understand why. The headline numbers are pretty good, but it does look a lot like demand pulled forward in pretty much every way that I can see here, Steve.
Steve, I was really glad to just get a plan. That was what I was sort of crying out for when I was a Diageo shareholder. I held the shares for about 6 months on the promise of a plan was coming, and it never came. We did actually start to get the remnants of an idea of what it was that they were going to do. So they reckon there's about $500 million in cuts that they can make. This was the new finance chief coming in, Nick Jangani. He said that substantial cut in costs. That would be things like trade investment, advertising spend, general overheads, and cutting supply chain. They also want to make significant asset disposals by 2028 to essentially turn around performance and reduce debts. Now, I thought that the part of the plan on the debt didn't really make any sense to me whatsoever. They want to reduce the leverage ratio from 3.1 times net debt to 2.5 to 3 times. Now, I hope it would fall a lot further than from 3.1 to 3. That doesn't sound like significant disposals or cutting costs. That sounds kind of strange to me. But yeah, they said that there's significant opportunities for what they would call substantial changes versus just trimming. It's going to be above and beyond the usual smaller brand disposals that you've seen them do over the last 3 years. They were pressed on whether that would mean Guinness was going, and Deborah Crew said nothing has changed. But that doesn't really answer the question. They actually think the cost cuts just on their own will deliver about $3 billion in free cash flow from fiscal 2026. And because of the tariff changes that we've seen recently, they've actually revised down what they thought the hit would be. They said that there's not going to be large-scale redundancies, although there will be cuts to headcount and slower hiring as well. So that was pretty interesting. And yes, Steve, as you said, we're getting Diageo Luxury Group, which is sounds a bit LVMH-y, I guess. They're basically bringing all of the big exclusive brands and their experiences together under this one division. They're going to have their own specific leadership team. It's going to be home to things like Premium, Johnny Walker, Expressions, Don Julio, Casamigos. I think it's called Ciroc, the vodka. A few others, but it's also going to have the Johnny Walker Princess Street experience in Edinburgh, the tour of the Port Ellen distillery that they've opened up, the fine wine merchant, Justerini and Brooks is also going under this umbrella. And it's actually a market that they've had a lot of success in. The sort of super premium segments of the market are growing about twice as fast as the rest of the industry. And in the last 10 years globally, premium and super premium spirits have gone from about 26% of the market to about 35%. So that lower end of the market is getting chipped away. I think people are thinking, if I'm going to drink a whiskey or if I'm going to drink a tequila or whatever, it might as well be an actual decent one rather than the sort of Asda Smart Price vodka. But who cares when you put an orange juice in it or whatever? So yeah, I actually thought this was a decent a decent like sort of beginning of a plan here, Steve. The market is still not really sure about this company year to date. It's down about 20.5%. And then if you look at that in the sort of 5 years, that's 27.5% down. So it's been a long term loser for people, despite a nice hump in the middle where you could have potentially have got rid of it. But yeah, I think it's the formations of an interesting plan. Now, I still worry about the latest generation of kids, or probably the latest two generations of kids, not really drinking as much, and how that will affect them. And yeah, I can see how this would work. I suppose if they are going to drink, they might be of the mindset where if they are going to drink, it'd have to be something good. And when it comes to the something good, Diageo has a decent chunk of that market already in the UK and abroad, and yeah, it could be the right strategy. I think.
We'll see on that bit. I agree with you about the leverage ratio thing. I would hope, maybe I'm wildly optimistic here. I can't remember whether they index this against cash earnings or cash, so EBITDA or free cash flow. But I would hope you could bring your leverage ratio down from 3.1 to 3 without actually reducing your debt at all. I was sort of thinking maybe you could just grow the bottom number a bit to take it from 3.1 down to 3, because that's not a huge growth number. Just make the bottom number that you divide it by bigger, which is like grow, basically. So, yeah, hoping for better in terms of reduction from that. And one of the reasons that I think they are in a slightly higher leverage ratio is because it's not a great time cyclically for them, which is fine. Your debt numbers do go bigger if or your leverage ratios do go bigger if your earnings go a bit get drag along the way. But there was indeed that bit of a kind of hump in the middle. I'm sort of impressed by their super premium range. I like the idea of if you have an asset like Johnny Walker and you have distilleries in Scotland and so on and so forth, yeah, use them for that, because I think there will be enough people that have got enough money that's worth something to them. It feels to me like a little bit like they're in the wrong. Well, the kind of trend that we're observing in the UK, or at least I'm observing in hospitality, is that the big winners, there haven't been anyone winning big, but the least affected by the pressures on hospitality at the moment are pubs, and the worst affected are bars, is what I seem to see nearly every month that I look at the index for this thing. And I strongly suspect that bars are more of a spiritsy place and pubs are more of a beer and wine place. I could be wrong about that, and it does indeed seem like beer and wine are sort of losing market share, and they are the parts of the alcohol market that I really wouldn't want to be in right now, despite the kind of sense of, well, buy low on this. I think the pressure is on there a bit more. But yeah, I thought this was kind of fine. Basically, it didn't really cause me to want to do anything. Sometimes when I get a stock that's on an annoying odd number of shares, I end up making it into a number that ends in a 5 or a 0, because that's the kind of person I am and how seriously I think about my investing. But beyond that, I don't really see a huge amount here to do. But we'll keep an eye on it. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.